One of the things that a lot of people seem to be interested in are the strategies I use. They want to know what are my favorite option strategies. Some people want to know what option strategies I don't like to use. And I thought that would be an interesting kind of video to make today. So today I'm going to discuss my favorite and my least favorite option strategies. So my favorite and least favorite strategies, why I like some option strategies more than others. And the first thing you need to know, this is all subjective. This is all my personal opinion. It's all personal to me. The things that I like, you may hate. The things that I hate, you may love. And there's no right or wrong answers when it comes to which option strategies you will like to use and which ones you don't like to use, because there's literally hundreds of option strategies available to you, and they all have viable use cases under certain conditions. And while it's crucial as an options trader to be familiar with all of the common strategies, naturally you're going to gravitate to a few core strategies that resonate with you personally. The strategies that you like and dislike, they're going to depend on a variety of things, including your account size. Do you have a large account? Do you have a small account? What's your risk tolerance? Do you want to take a lot of risk, or do you want to take as little risk as possible? Also, it may be based on the hours that you have available that you can actually trade. But most of all, it's based on your personality type. The following slides are going to list my favorite and least favorite option strategies, but remember, again, this is subjective opinion. Just because I like or dislike a particular strategy doesn't mean that that strategy is necessarily good or bad. So let's start with my least favorite option strategies. So for me, I definitely do not like boring trades that take a lot of time to make a very little amount of money. So I do not trade things like box spreads. Box spreads are where you buy a long call spread and a long put spread at the same strike. So you essentially box yourself in. Typically this is done on things that have no assignment risk. So you do this like on SPX, and you put on this box trade, and you're essentially putting all of this money, you're tying up all of this buying power to make the risk-free rate. You're just trying to make a few percentage points on that trade by holding it for a few months or a year or whatever time you're in the trade. For me, that's not a trade I want to be in. I want to make more money than what I could make on a box trade. I want to take a little risk. I don't want the risk-free rate. If I wanted the risk-free rate, I'd just buy some bonds and be done with it. I'd buy some T-bills, but that's not what I'm doing, right? The reason I'm trading is because I'm looking for a little bit more action and a little bit more reward than what a box spread can do for me. I also never trade collars, and collars, oddly enough, you guys are very interested in collars, because I've gotten a few people ask me, hey, could you do a video about doing collars? But they're not a trade I would ever put on. I would never put this on as an opening trade because it's very boring, because you're limiting yourself on your upside potential. You're also limiting yourself on the downside because you put up these fences around shares of stock. Let me show you an example of a collar. I've got this here in TASTYTRADE that I went ahead and put on as an example trade. This is Apple. In Apple, I buy 100 shares, and then I've created this collar around it by selling a call, your classic covered call, right? I can profit until 240, and then that's the max profit. You know, that's the max potential to the upside. I've capped my upside potential by selling that call, but I've also capped my downside risk by buying this lower priced put here. So it looks very much like a vertical spread, right? It looks like a credit spread or a debit spread as far as the risk profile. That's essentially what it is, kind of synthetically. But for me, I don't do this. And again, that's just a personal choice of mine. It's a trade, again, that I just don't care for. Another strategy I never use are calendar spreads. Calendars, they're kind of boring. They take a lot of time. Some people actually call them time spreads. A calendar is where you sell a shorter dated option and then you buy a longer dated option. They're at the same strike, so there's really no delta play. It's purely an extrinsic value play where you hope that further dated long option retains its value or even gains some extrinsic value, while your short option that's nearer dated loses extrinsic value. And you know, basically it's an arbitrage play kind of on the extrinsic value of those two options. And again, it's a very boring, very slow working kind of trade. I never trade calendars. Other trading strategies that I don't like are neutral trading strategies that have 50% or less probability of profit. And this is typically iron flies and straddles that I'm talking about here. So if I go back to my trading platform, let's do your standard straddle here in Apple. So I'm just going to sell the at the money call and the at the money put. This is a straddle. Now in this particular example, it says my pop is 53%. So it's above 50, but it's really like a 50-50 kind of trade here. I'm going to receive $1,563 credit. So I get a ton of premium for selling both the call and the put, especially since they're at the money, right? But you know, I'm getting a ton of premium, but I'm taking a lot of risk because again, it's basically a 50-50 coin flip on a straddle. And for me, you know, I'd much prefer doing something like a strangle to give myself a much higher probability of profit. Now I have to give up a lot of that premium, but I will prefer giving up some premium for a higher chance of winning on the trade. So straddles, I don't like, even less, I hate the iron fly. This is not a strategy I like. I clicked the wrong button there. I should have bought. You can see this particular example, iron fly, probability of profit, 37%. That's a horrible probability of profit, very low probability trade. Yes, you get a ton of premium, and I've defined my risk to the upside and the downside by buying the wings. So buying power effect is actually not very big, but these are kind of trades that, again, I would much prefer strangles and iron condors rather than straddles and iron flies. But again, that's a personal choice of mine. And the last of my least favorite strategies I'm going to talk about today is the naked short call. I don't sell a lot of naked short calls as far as a naked short call by itself because it's way too risky. And I've been burned on naked short calls a lot in the past. For one thing, the stock market tends to go up, so naked short calls tend to get tested a lot, especially on the index products like the SPY and QQQ, you know, just selling calls on those things. They have a negative expectancy. I just don't do that. And then in single stock, you have single stock risk of, you know, like an earnings event where a stock explodes in price, like a stock just goes up 50% overnight. And I've had short calls on stuff like that, you know, burn me where I've lost thousands and thousands of dollars on a naked short call because, you know, I was a bonehead and I put something on for earnings that involved a naked short call. So I just don't do naked short calls all that often. Now let's talk about my favorite option strategies. Obviously, my favorite option strategy are the wheel trades, right? All the wheel option strategies. Heck, I even wrote a book called The Super Wheel Option Strategy, available on Amazon. Check the link in the description below for the book. But I love short puts or cash secured puts. So just selling puts. That is my most common trade. Probably 70% of my trades are simply selling puts. I also love covered calls. So anytime I get shares of stock, I love selling covered calls around it. And I especially love selling covered strangles around it. I did that a lot this year, especially with NVIDIA. I was wheeling NVIDIA a lot this year. Sold a lot of puts, sold a lot of covered calls. And sometimes I even did covered strangles where I had shares of NVIDIA and I was selling both puts and calls around it, creating the covered strangle. Other favorite strategies of mine include neutral trades that have a greater than 65% pop. So remember, my least favorite trades were neutral trades that have 50% or less pop. So I didn't like the iron flies, I didn't like the straddles, but I do like strangles and iron condors. Now, one caveat with the iron condor is I like strangles. Strangles are fine. Iron condors, even though they fit this category of my favorite trades, neutral trades that have 65% or better pop, they also have a negative. Iron condors kind of fit into the boring trades that take a lot of time to make a little bit of money. So iron condors, I trade a lot of them, but they're probably my least favorite of my favorite trading strategies, if that makes sense. And finally, the third category of my favorite strategies are the ratio spread strategies. So ratio spreads, the most common ones I use are the front ratio spreads, especially put ratio spreads. I sell a lot of put ratio spreads on various stocks, ETFs, indexes. Sometimes I will use back ratio spreads kind of as a hedge. They work perfectly. For example, I do a lot of back ratio spreads in MES where I will sell like a 16 delta put to finance 2 or 3 much lower delta long puts, and the 16 delta put, as long as I profit on it, will pay for all the long puts. That's kind of like me getting a free hedge at that point. I should do a video on how I use those back ratio spreads as a long put hedge in MES. I'll try to make a note of that and remember to give you guys that content coming up. I also like ladders. Ladders are essentially a ratio spread, except instead of, like, for example, having the two short puts at the same strike and then the long put, you split up the two short puts. So you have short put, long put, right? So it's basically a short put plus a put debit spread is what it is. So these are ladders. The Tasty Trade guys call them over easy and sunny side up, depending on whether you're doing them with puts or calls. Some people call these ladders the Christmas tree. On YouTube here in the last couple of years, a lot of traders on YouTube have been trading these ladders, and they call it the 111, which I don't like that name. It's not very descriptive. 111 what, right? Especially since you can make ladders out of calls and puts, and you can do them whether you're long the ladder or short the ladder. You can basically have 4 different types of ladders. The 111 strategy that all these YouTubers are talking about, or actually a long put ladder, or typically what I call it a bear put ladder, but there's also bull put ladders, bear call ladders, and bull call ladders as well. But they're all versions of ratio spreads. So there you have it, my favorite and least favorite strategies. And really it all comes down to personality type. It comes down to, do you like a lot of action? Do you want a lot of action, or do you want, things to be kind of slow and boring? For me, I like a lot of action. So as you can tell, my least favorite trades were the boring trades. My favorite trades are the trades that tend to work out quickly. That's why I love short puts. You put on a short put, if you get it right, I'm in and out of that thing typically in a week, maybe 2 weeks, right? Those things work out very quickly, where something like an iron fly or a calendar spread is going to take some time. I don't like those trades, but again, that's my personality type. But some traders actually prefer the opposite. Some traders prefer the boring, slow strategies. A lot of traders love calendar spreads, especially if you're the kind of trader that is limited on how many trading hours that you can dedicate to trading. Maybe you have a full-time job. You can't be in front of a computer that many hours a week. You can only, just dedicate just 2-3 hours a week maybe to trading. Then you might prefer some of those slower, boring strategies, the safer strategies. Yeah, you're not making a ton of money on those, but you're not really taking a lot of risk, because you can't put on, for example, a bunch of naked strangles and then just stay away from the computer for a couple of days. That's a bad idea. No strangles, for example, can move against you in a big way. So again, a lot of it comes down to how much time you can dedicate to your trading. But again, there's no right or wrong answer here. This is all personal choice. It's all subjective. So what's your favorite and least favorite strategies? Let us know down in the comments below. I'd love to hear what you guys are doing. Now, if you'd like to help support this channel, please consider subscribing to the DT Options Discord. You'll find me over there for the first hour of each and every trading day. I hold a live voice chat over there where I share my screen. You guys get to see my trading platform. You get to see all the trades I make for that first hour of each and every trading day. Also, over on the DT Options Discord, you'll find all the PDF slideshows from all of my videos of the past. Got a little section over there where you can get the slideshow, for example, from this video if you want it. So go check that out as well. You'll find a link to the DT Options Discord in the description below. Peace, guys.